Welcome again. So this is the first part of Chapter 6, Revenue Recognition. So let's go. So what is revenue? The first one is the revenues are inflows or other enhancement of assets of an entity or settlements of its liabilities or a combination of both, from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. So it means that revenue is the inflow of assets. So it means the asset will increase due to revenue and the liabilities will decrease, correct? Then it is important not only to determine how much revenue to recognize or record, but also when to recognize it. Okay, so this is really important. How much of the revenue will be recognizing and when to recognize it. So the revenue recognition, it has two important questions. The first one is how much should we record and when to record. Okay, so now come to the revenue recognition principles. The prior generally accepted accounting principle, it is saying that revenue should be recognized when the process is complete and there is a reasonable certainty as to the collectivity of the assets to be received. So there are some problems in the realization principles of the gap. So the revenue recognition was poorly tied with the first B's conceptual framework. The second one, so this realization principle focuses on the earnings process led to similar transactions being treated differently in different industries. And the final one, it was difficult to apply to complex arrangements that involved multiple goods or services. So that is why we needed a new, more focused revenue recognition principle. So that is what has been done in 2014 by Financial Accounting Standard Board, FASB. So the Accounting Standards Update ASEU number 2014-09, Revenue from Contracts with Customers. This is the new law of recognizing revenue. So it provides a unified approach, okay, that replaces more than 200 different pieces of specialized guidance that had developed over time in US GAAP for revenue recognition under various industries and circumstances. And the core principle is that companies recognize revenue when goods or services are transferred to customers for the amount the company expects to be entitled to receive in exchange for those goods and services, and when upon transfer to customers, and how much the amount the seller is entitled to receive. Okay, and now let's see one example of this one. So think that this is the total work. Okay, this is the line of the total work, and let's divide this work into different pieces. So this is the 25% of the work. So suppose we have done these 25% of the works. Okay, so we will be receiving the 25% of the total revenue. So 25%, and say we have performed these 75% of the work. So we will be receiving this 75% of the revenue, total revenue. Okay, so this is how the new revenue recognition principle works. Okay, now there are 5 steps in the revenue recognition principle, the new one. So the first one is the step 1, identify the contract. Step 2, say for example, you and TNT have agreed on one contract. Say for example, you have ordered an iPhone with the TNT line. Okay, so you have reached in a contract and you will pay $1,000, okay, for these two services, iPhone and TNT. So you have agreed. So there is a contract between you and TNT. Step number 2, identify the performance obligations. So what are the obligations from the TNT? There are two obligations. The first one is to deliver the iPhone and the second one is to provide services by the TNT. And the step number, it should be 3 actually, not 4. Step number 3. Step number 3, determine the transaction price. So the transaction price is 1,000. Step number 4, allocate transaction price. So out of these $1,000, say we are allocating 900 for the iPhone and 100 for using the TNT line, and say for example this one is for 2 months. You are giving 2 months advance, 50-50, okay. And step number 5, recognize revenue when performance is satisfied. So we have 2 steps. So the first one is TNT will deliver you the iPhone, and the second one is they will be continuously providing you network services, okay. So the first one is delivery of iPhone and the second one is monthly line bill, okay. So order and delivery of iPhone. The first one, January 1, 2021. After the confirmation of order and receiving 1,000 for iPhone and network services, TNT will record. So this is the first journal entry on January 1st from the TNT. So they have received $1,000 cash. So cash debit and unearned revenue credit. So sometimes in the books they are saying deferred revenue. So they are actually interchangeable. You can either use the unearned revenue or the deferred revenue, okay. And say for example on January 15, 2021, TNT has delivered you the iPhone. So after the delivery, the TNT records. So unearned revenue debit and sales revenue credit, because they have already delivered the iPhone. So that is why they have debited the unearned revenue of 900, because they no longer have this liability, okay. And they have recorded the sales revenue because they have already delivered the iPhone to you. And telephone service, the monthly bill will, after rendering the first month's network services, TNT records assume that per month bill is $50. So on January 31st, they record the unearned revenue debit and service revenue credit. And the second month, so the remaining $50, so they will be recording on February 28 unearned revenue debit and service revenue credit. This is service revenue, see that, because they are providing you services, okay. And now the 5 steps to revenue recognition. Step number 1, we already have discussed. The identify the contract. So the legal rights of seller and customer established. So you have signed a contract and you have paid the money. So the identify the performance obligations. What are the obligations from the seller? The seller may have single, say for example, if you just order an iPhone from Apple, so they have only single obligations to deliver the iPhone. But if you order iPhone with the connection from the TNT, so they will be giving you 2 services. The first one is the delivery of iPhone, and the second one is the continuous service by providing the network. And the third, determine the transaction price. So amount seller is entitled to receive from the customers. The same thing for the single and multiple. And allocate the transaction price. So you will be allocating the transaction price if you have multiple obligations, okay. So in case of, you can see that in case of single obligations, you don't need to allocate because you have only one performance obligations. And In case of multiple obligations, you will allocate the transaction price based on the ratio of the price and recognize revenue when each performance obligation is satisfied. So in case of single obligation at a point in time or over a period of time, if you need to perform the works step by step, so there are many periods, so you will be recognizing revenue in different points. Okay, and in case of multiple, the same thing, what is appropriate for you. Okay, so at a point in time revenue recognition, the customer is more likely to control a good or service if the customer has an obligation to pay, legal title, physical possession, and assumed the risks and rewards of the ownership and accepted the assets. So recognizing revenue at a single point in time, say for let's have an example. So the TrueTech Industries sells Tribox, okay, and the Tribox is only a gaming module and includes no other goods or services, no other one. Okay, so when show the TrueTech recognized revenue for the following sale of 1,000 Triboxes to Comstores. This is the situation December 2020. So the Comstores orders 1,000 Triboxes at a price of 240 each, promising payment within 30 days after delivery. So when, just guess, when we should recognize revenue? Should we recognize revenue on December 20? No entry, because it's just an order. So you have not yet provided the services, meaning the Tribox, or you have not yet received the money. So this is just an order, okay? And on January 1, 2021, the TrueTech delivers. Now there is a transaction, okay? So the TrueTech delivers 1,000 Triboxes to the customers, the Comstores, and title to the Triboxes transfers to the Comstores. So what happens now? So on January 1, TrueTech records the accounts receivable debit and sales revenue credit. Okay? And on January 25, the TrueTech receives 240,000 from the customer. So they receive, so they record cash debit and accounts payable credit. Okay? So let's solve the problem set 0501. So in the next video, we'll be solving the problems. Thank you.